Applied Materials is seeing an incredible move today, and as of this moment, January 15, 2026, at 11:40 a.m., the stock is trading at $325.82 USD. That is a massive jump of 23.93 points, or about 7.93% in a single session. This intraday spike is not just a random fluctuation, it is a clear signal that the market is recalibrating its expectations for the semiconductor equipment giant. While many investors were bracing for a quiet start to the year, this sudden surge suggests that big institutional players are positioning themselves for what they believe is an inevitable acceleration in the hardware side of the intelligence boom. This price action brings the market cap to roughly $258 billion, and we are seeing high-volume conviction that is rarely seen outside of major earnings surprises. Now, here's the insight you probably didn't see coming. While the general market is obsessed with the software side of chips, the real bottleneck has quietly shifted to the physical manufacturing limits of high-bandwidth memory and the machines that build them. Everyone is watching the chip designers, but the reality is that the actual production tools are becoming the scarcest assets in the entire tech stack. Most people look at Applied Materials and see a steady, old-school industrial company that provides the plumbing for the digital world. The common ground here is that investors generally view this as a cyclical play. Buy when the economy is up, sell when it's down. But that view is fundamentally flawed in 2026. The deeper reality is that we are no longer in a simple cycle. We are in a multi-year structural shift where the complexity of chip making is outstripping the capacity of existing equipment. If you are still using 2019 mental models to judge this company, you are missing the fact that their revenue is becoming far more recurring and high margin than it has ever been in the past. If you look at the recent stock movement, this 8% gain today is part of a much larger narrative. Over the last few weeks, the momentum has been building as analysts from major firms like RBC Capital and Bank of America have started raising their price targets, some as high as $385. This isn't just optimism, it's a reaction to the data. Trading volumes today are significantly higher than the daily average, indicating that this isn't just retail enthusiasm. We are seeing major inflows through individual brokerage accounts and institutional desks alike. There is a palpable tension in the market because for months the expectation was that China trade restrictions would cripple the top line. The reality we are seeing in the trade data is that while China revenue did drop to about 28% of total sales, the demand from other regions, specifically North America and Southeast Asia, has more than compensated for that loss. This is a classic example of expectation versus reality. The market expected a massive hole in the balance sheet, but reality delivered a diversified and more resilient revenue stream. The intraday volatility we're seeing is also a reflection of the broader semiconductor sector. When you look at the performance of the Fidelity ETFs or other technology-heavy funds, you can see a rotation away from speculative software into hard infrastructure. Applied Materials sits at the absolute center of this. Even if you were using a Robinhood app to trade fractional shares, you can see the influence of the big whales. The short interest in this stock actually dropped by over 20% in the last month, which tells you that the bears are finally throwing in the towel. They realized that betting against the company that provides the literal tools for the next generation of computing is a losing game. The institutional activity suggests that the smart money is no longer worried about a 2026 recession. They are worried about not having enough exposure to the equipment that makes advanced logic and DRAM possible. Let's talk about what this company actually does for a moment, because it's important to understand why they have this kind of moat. Applied Materials is a leader in materials engineering. They don't just make machines, they provide the systems that allow companies like TSMC, Samsung, and Intel to manipulate atoms. They are the ones who make chemical deposition, ion implantation, and physical deposition possible at a microscopic scale. Their business model is divided into three main segments: semiconductor systems, applied global services, and display and adjacent markets. The The systems side is where the big machine sales happen, but the service side is the unsung hero. This part of the business provides the recurring revenue that keeps the lights on during down cycles. It's like selling the printer and then making a fortune on the ink and the maintenance for the next decade. Their older reports showed a heavy reliance on the display market, but that has shifted. Today, the focus is almost entirely on advanced logic and memory. In fiscal 2025, they hit a record annual revenue of over $28 billion, and their earnings per share beat expectations across all 4 quarters. This track record of over-delivery is why the market is reacting so violently to positive news today. When you look at the future outlook, there are several massive catalysts on the horizon. The first is the ramp-up of 2-nanometer and angstrom-class chip production. As the industry moves to these incredibly small nodes, the equipment required becomes exponentially more specialized. Applied Materials is positioned to be the primary provider for these tools. Furthermore, their high-bandwidth memory business is expected to double in the next few years. They are targeting $3 billion in HBM-related revenue alone. This is where the expectation of steady growth meets the reality of explosive demand. If you think about it, every single AI server needs massive amounts of HBM, and you can't make that memory without the specific hybrid bonding tools that only a few companies in the world can provide. This is a massive opportunity that many investors are still undervaluing. Comment below how many shares of Applied Materials you currently hold, or if you're looking at other semiconductor equipment plays right now. I want to see how many of you are playing the hardware side of this market. Of course, it isn't all sunshine and rainbows. The risks are real. Geopolitical tensions remain the biggest wild card. If the government passes even stricter legislation regarding technology exports to certain regions, it could put a temporary dent in the growth trajectory. There is also the risk of a CapEx digestion period. If the big chip makers overinvest in 2025 and 2026, we could see a slowdown in 2027 as they wait for demand to catch up to their new capacity. But even then, the service revenue provides a floor that didn't exist 20 years ago. The macroeconomic pressures of inflation and rising labor costs are also factors, but Applied Materials has shown a remarkable ability to maintain its margins through efficiency gains and pricing power. Their 2026 guidance suggests they are looking at earnings per share between $1.98 and $2.38 for the next quarter, which is quite strong considering the traditional seasonal patterns. One thing that is really interesting to watch is how this stock is being handled on modern platforms. Whether people are using interactive brokers for their deep professional tools or just checking their SoFi Invest account for a quick update, the sentiment is shifting. We're seeing more and more people looking for investment help to understand these complex technical themes. The move towards self-investing has actually increased the volatility in these names because more people are reacting to the same headlines simultaneously. However, the long-term investors, the ones using Schwab Intelligent Portfolios or Fidelity Wealth Management, are generally staying put. They see the dividend increases, with 2025 marking the 8th consecutive year of hikes, and they see a company that is consistently returning value to shareholders. To summarize the situation we are seeing today, Applied Materials is currently in the middle of a massive breakout. The expectation was that the company would struggle with China headwinds and a slowing cycle, but the reality is a robust, diversified growth story driven by the physical requirements of the AI infrastructure build-out. Today's price of $325.82 is a reflection of that reality finally setting in for the broader market. We have seen institutional volume, multiple analyst upgrades, and a technical setup that suggests there is still room to run. The company's leadership in HBM and advanced logic nodes makes them a gatekeeper for the entire tech industry. While there are geopolitical and macroeconomic risks that could create some bumps in the road, the fundamental story is stronger than most people realize. The contrast between the cautious cyclical narrative and the reality of a structural growth powerhouse is what has driven this 7.93% spike. As we head into the next earnings report in February, all eyes will be on whether they can maintain this momentum. For now, the bulls are clearly in control, and the plumbing beginning of the digital world has never looked more valuable. As you look at your own investment strategy, whether you are utilizing online investing tools or working with an individual brokerage, it is crucial to separate the noise from the signal. The noise is the daily fluctuation. The signal is the massive increase in the complexity of chip manufacturing that requires applied materials expertise. If you are looking for investment help, always remember that the companies providing the tools for the winners are often more stable than the winners themselves. The semiconductor industry is hitting a $1 trillion milestone in 2026, and you simply cannot reach that number without the machines from Santa Clara. It is a reality that is finally being priced in, and today's price action is the most evidence-based proof of that shift.